absolutely, revenge travel happened. I think also what everybody assumed is that people are going to be scared to travel after COVID, right?
But it's just that the surprise element of how it came back and how sustained the demand was
Correct.
came in as a very large surprise compared to what people would have ideally estimated human
Right.
behavior to tend towards.
What do we tell our listeners? That buy every stock that is available within this industry and
Only if it were so easy.
This episode of Taking Stock is brought to you by Paterson. All right, hello and welcome to another episode of Taking Stock. This is a weekly podcast where every week we pick one company, one stock and dive into it. This week, this is a slightly different episode because we're not going to be talking about one particular stock, but we're going to be talking about an industry as a whole. Right, so the podcast today, as you must have already seen on the thumbnail, is about the great Indian hotel industry. Right now, the first thing I think we should start with is what happened to the hotel industry in India with COVID about 4-5 years ago.
It surprised everybody.
Correct.
So
True.
everyone thought people will stick around at home and not go anywhere, and that must have happened for the lockdown period. But after
Correct.
that, it went ballistic.
Right.
So in terms of travel and tourism, it just shot up. Revenge travel was the popular term at that time. But that resulted in a place where out of nowhere, and initially a lot of the hotel companies were beaten down as stocks because these are like businesses which went vacant, right?
Correct.
So
they were vacant for COVID wasn't a one or 2 week thing, right? It was on and off. I mean, with the first wave and the second wave and all that.
Yeah.
It was almost a year and a half, maybe 2 years that it lasted, which impacted the bottom line of all of these hotels massively, I'm assuming.
For a short duration, because after that
Right.
a lot of people also started staying in hotels, right? Because you get room service and
In hotels.
yeah, I've heard of so many
How
people like staying
privileged
in-
are you?
booking out Land's End for like a month altogether. You haven't heard that?
No, I mean, I don't know about this. If there's anybody who stayed in a hotel for 1 month for room service, let us know in the comments, please. But anyway, yeah, so absolutely, revenge travel happened. I think also what everybody assumed is that people are going to be scared to travel after COVID, right? People are going to be working from home, so business travel will reduce. But that obviously wasn't the case, right? And I'm assuming since 2023, 24, 25, now we're in 26, it's only kept on increasing.
Yeah, I mean, it's continued. You obviously saw like a massive dip for FY21, which was the COVID year, and then a massive spike after that. That's pretty much every single graph you see is going to show you that one little valley.
Correct.
Big valley, in fact, for FY21.
Right.
And that's happened with the hotel industry as well. But it's just that the surprise element of how it came back and how sustained the demand was
Correct.
came in as a very large surprise compared to what people would have ideally estimated human
Right.
behavior to tend towards.
Yeah, you always, I mean, I understand the term revenge travel or whatever, right? But you'd expect it to normalize or correct itself at some point, which I don't think has happened yet.
Yeah, I mean, see, the immediate was that there was a 30% growth rate. That was the rebound. And then it's obviously normalized to a place where now it's still in double digits. It's in healthy teens,
Right.
the growth rate. But it's not normalized down to like a single digit.
And it doesn't show any signs of, right?
No, not really. Because if we sort of look at the numbers from FY22 to 25, the demand actually grew by 21% CAGR. Whereas the supply grew at 8% CAGR.
Right.
So this resulted in a massive sort of, I wouldn't call it a crunch, but a favorable situation for hotels, because what effectively happens when this sort of a situation takes place is that occupancy rates go up.
Correct.
And somewhere around 75% is where they peak out for any hotel.
Okay.
75% is the occupancy rate.
So,
which is,
so if a hotel is having 70-75% occupancy rates, that they're doing well. They're in a good space.
that sort of global norm of maxing out.
Right.
75%.
Okay.
And on top of that, and in any case, if they're at 75%, they get a lot of pricing power in their hands.
Understood.
Because that means the demand is so healthy and they're going full.
Right.
So they can actually increase the pricing a little bit, and that also becomes a favorable output. So there is a metric actually called RevPAR, right? Like, which is revenue per available room.
Okay.
Which is basically your average room rate multiplied by the occupancy rate.
Understood.
So this is at like all-time high levels at this point in time.
Right. It's so essentially this is because the demand for hotels or rooms or whatever you want to call it has increased.
Yeah.
And it's increasing much faster than the supply of rooms or hotels, right? So obviously hotels are in a position where they can increase their prices. Right, and that's what's happened in the last few years, right?
Yeah, and I think what you got to understand is also the fact that there is a larger undercurrent in the entire hotel industry, which is basically your branded hotels are capturing a larger share compared to unbranded and single hotel kind of scenes.
Okay.
So if I just have to sort of take a step back, there would be about say 25 lakh rooms.
Okay.
In India,
okay.
Right? Hotel rooms.
Right.
Out of that, about 2 lakh are branded.
Okay.
So that's merely 8% is branded.
Right,
The rest are single establishments, non-branded, etc., etc.
Right.
Now, if I have to look at the total number of rooms being added, so in 2024, about 15,000 rooms got added into the industry.
Okay.
All of the 15,000 rooms were branded or organized.
Oh, okay.
So the share of branded, incremental share of branded.
But is it because the data for that branded is easier to capture than the unorganized market?
Not really. Think about it this way. There are a couple of factors that result in this. One is that basic middle class is rising in India.
And that's aspirational aspect of it.
Yeah. So, and at the end of it, if you're staying in a hotel, what a brand essentially does is it provides you the comfort of knowing that that place is hygienically going to be there.
Correct.
It's going to be at par. Your basic
it's going to be
requirements
of a certain standard that you expect, right?
So because of that, and because of the other factor being that online reach is also much larger for branded players compared to unbranded.
Correct.
So all these factors put together result in branded capturing 100% incremental share,
right?
But they're at only 8% share when it comes to the overall numbers.
Correct.
So what's effectively happening and what's affecting this demand supply change is that demand is increasing for the overall industry.
Correct.
Much higher for branded, but the supply can't catch up because the industry is so small compared to the overall numbers.
Right. This episode of Taking Stock is brought to you by Paterson. And there's a couple of reasons you would peg this down to, right? One is that, okay, the branded ones, the branded hotels have a much higher aspiration level that has been created. It is the standard of service. It takes away the uncertainty of, is this going to be a good space to stay or not a good space to stay? Where if you're going with a branded player, you know it's going to be a good place to stay.
Yeah.
Right? So I think those are the basic factors. But if you sort of, why do you think the demand, okay, let me rephrase the question, right? What I'm trying to get at is that, is this trend going to continue? Because there's also a big shift towards, Airbnbs, homestays, and those all fall into the unbranded category, right?
Yeah, but this trend is sort of there to continue because at least the numbers that are there for so for example, there is about 1,15,000 rooms that are coming up. That's the pipeline. And that pipeline, 80% of it is still unbuilt. It is going to come over the next 4 to 5 years.
Okay.
Again, most of it is organized. So what's happening is effectively, even when you talk about these homestays and stuff, there are a lot of these properties which are being taken over by brands like Saffron, for example.
Correct, right.
So that is also moving into a branded space because Airbnb also does not guarantee that the place will be good.
Absolutely. I was actually recently reading about this where the northeast of India has suddenly risen in terms of as a tourist destination. There's a lot more people now wanting to travel to the northeast. It's become a place to visit or a region to visit, etc. And as soon as that's happened, all the big brands have now started setting up properties there.
Yeah. So I think this is a trend that will continue because at the end of it, demand is rising much faster than supply. And supply, the thing is, takes time to come.
Right.
Because a hotel can't be established overnight.
Correct.
It is a project which usually lasts longer than your usual projects because it has to be so much more curated, planned, processed, and then the build time is so much more. So at the end of it, I mean, this is a trend that will continue for at least the next 5 years.
So essentially, I mean, what we're establishing is, so when you say that this trend is going to continue at least for 5 years, and if maybe more even, right? What we're essentially establishing is that overall as an industry, every player within this industry, or especially the branded players, are looking at major growth coming up.
Yeah, so if I have to sort of just broadly classify the industry into branded and unbranded, right? Branded is about 8% of total volume or
Correct.
supply. If I have to look at the revenue, branded is usually able to also command a higher revenue because there is a certain, whatever,
Right,
you
right.
mentioned those points. So an average daily rate of 8,000 on branded properties versus unbranded at about 2,500.
Okay.
Occupancy rates are also much higher on branded.
Right.
They're at about 70%, whereas unbranded is at about 50%.
Okay.
So if I have to look at the revenue split,
Right.
while 8% is branded
Right.
in terms of volume, they capture about 30% of the revenue of the
yeah,
industry.
because they're obviously charging more, higher
Yeah.
occupancy rates, etc.
And because they are higher occupancy rate and more efficient and brands, etc.,
Right.
etc., they capture about 50 to 60% of the total EBITDA.
Correct.
So effectively, what we are saying is that over the next 5 years, the branded space is the space that will do extremely well
Correct.
in the entire industry.
Okay, so now, what do we tell our listeners, that buy every stock that is available within this industry and sector?
Only if it were so easy.
So how do you, I mean, okay, so there has to be some classification within the branded sector also, right? So let's say now you have within the branded sector, you have a Taj and an Oberoi, which are at the higher end of the super luxury hotels, right? Your Ritz, your Marriotts, all of that. But also you will have business hotels, you would have lower end hotels, which are for frequent travelers, business hotels. What are the subcategories is what I'm trying to get at.
So see, basically I can categorize these into 5 broad buckets, right?
Okay.
One is your luxury or 5-star.
Right.
That is an average daily rate about 17,000 bucks. Then comes upscale,
Okay.
which is 10,000 bucks daily rate. Then is mid-scale
Right.
at about 7.5, mid-economy
Right.
at 4, and economy or budget at 3.5.
Fair enough.
That's how it stacks up.
And this is all within the branded side of it.
Yeah, just
Yeah,
branded.
yeah, okay.
Let's exclude unbranded
Fair enough.
altogether. Now, in this is how the 5 categories stack
Right.
up. If I have to now look at the occupancy rates of these at this point in time, the highest occupancy, so the occupancy rates are also flowing down in this priority.
Okay. So the luxury ones have the highest occupancy rate.
At this point in time, they're at about 70 to 72%.
Okay.
Upscale is 68 to 75.
Right.
Depends, obviously, the range.
Right,
gets
of
wider.
course.
Mid-scale is 68 to 80. Mid-economy would be 55, 56.
Right.
And economy would be 50, 55.
Okay.
So if I have to just figure out 2 metrics, right? What commands the highest pricing and has the highest occupancy at this point in time? That is the luxury space.
Correct.
So the luxury space is the one which is the fastest average daily growth rate because
Right.
they're having a lot of pricing power. They have the highest, also the largest amount of supply constraint.
Okay.
Because again, capital requirements for setting up these hotels are
Right.
very large.
And it takes much longer
It
to
takes
set up.
much
Yeah.
longer. The location is important,
Right.
etc., etc. There's a lot of things
Correct,
that go
correct.
into it. So the beautiful, I think, spot when it comes to the categories at this point in time is the luxury or the 5-star space.
Right.
That's the space. If you have to catch a theme within the hotel sector,
Right.
I think that's one place which is prime at this point in time.
And based on your opinion, I would say, or your perspective, you think this is going to continue?
This will continue because for the next 5 years, so let's take a 5-year view. I think for the next 5 years, this will continue because this will, it's already at the
Right.
demand supply gap is the highest
Correct.
when it comes to this. So the one stock, and not recommendation, I'm just saying which is the one stock that highest, so there are 10 to 15 listed stocks when it comes to
Within the
hotels.
luxury space?
No,
Okay.
overall.
Right.
So if I have to pick out the one name which is the most beneficial from this trend,
Right.
it would be IHCL, which is
Okay.
Indian Hotels,
Right.
which is basically a Taj.
Correct.
So out of about say 250 hotels, they have 2 properties in the luxury category, 2 brands.
Right.
That is Taj and Claridge's.
Right.
So both of these, they make up about 140 of the 250 hotels.
Right.
So that is the highest in terms of portfolio. Then they've got upscale, which is something called side. Can't read my handwriting. Sorry.
But that's part of the IHCL portfolio.
Oh, this is Selections. Sorry.
Right.
Selections and Vivanta.
Right.
That's about 100 hotels, which is upscale. Then they've got economy, which is Ginger, which is about 100 hotels.
Correct.
So in terms of exposure, number one, IHCL is the largest when it comes to the hotel industry
Right.
in India. And within that, the luxury part is the highest at about
Correct.
33% in terms of volume.
Right. So when you say that, the luxury segment of the top segment of within the branded hotels is set to increase over the next 5 years, 10 years, etc. Is this also got to do with just people having a higher disposable income, or people spending more on travel? Or
I think it's a function of everything. So one is, again, your demographic overall, how it is moving, how many people are getting added into the luxury segment. When there is economic stress, the ones that are least affected is the top bracket again.
Correct.
So a guy who's able to spend 17,000 bucks on average in a room, if you make it 19,000, it doesn't make a difference.
Doesn't make any difference, yeah.
So you're talking about a different category altogether, which is quite
not very price sensitive.
Yeah, the elasticity to price is lower.
Correct. And it's also, I mean, a little philosophical over here, but it's tougher to degrade your lifestyle once you get used to a 17,000.
No, also I think it roots down to a very relevant economic disparity factor, which is only rising. That disparity is not going down.
Correct.
So
fair enough. This episode of Taking Stock is brought to you by Paterson. Okay, so we've essentially established that luxury is here to stay and here to grow, right? What other theme would you sort of bank on?
So one is, the second is corporate travel.
Okay.
So about a third of India's hotel demand comes from business travel.
Fair enough.
It is not really leisure travel or whatever.
Correct.
So these are hotels that are in your metro cities or urban areas or industrial areas or whatever.
Right.
So just to highlight a few of those growth drivers, for example, Hyderabad, Bangalore, Chennai. These three especially are very, very high growth markets. Hyderabad, I think, has surprised everybody in the last few years in terms of how it has grown.
So it's essentially because you have your corporate offices, tech parks, etc. in these regions.
IT, pharma, commercially, you look at the traffic jams, that's a good indicator. So office space, for example, in Hyderabad has increased by 3x in the last 10 years.
Yeah.
So that is a huge number. So if I just talk about the ARR growth and the occupancy rate, maybe for all these three cities, right? So at Hyderabad, you're seeing 14 to 18% average room rate growth, and occupancy is at 75%.
Understood.
So super strong demand, highest occupancy when it comes to optimization, right? Similarly, Bangalore is at 14 to 16% ARR growth and occupancy of about 70%. Chennai ARR growth of 10 to 12% and occupancy of 70 to 74%. Right. So now what's happening is in all these three areas, there is a gap between demand and supply when it comes to projections for FY 25 to 30.
Correct.
So Chennai, for example, Hyderabad, demand is expected to grow at a 8% CAGR.
Right.
Supply only at 5%.
Correct.
So on average, there is a 3 percentage points gap between the two.
Correct.
And all these three, nobody is going to, not a lot of people are going to Hyderabad to sightsee or whatever.
People might be, but obviously I understand what you mean.
So
it's not an offbeat destination on your bucket list.
So what's happening in these places is that anybody with a very strong presence in these cities and whoever is playing it smart is able to capture majority share or benefit from this.
Correct.
So I'll give you one more example of like we did IHCL as an example in the first one.
Right.
The example here is a company called Chalet.
Okay.
So Chalet Hotels is a part of Raheja Group.
Right.
Now Raheja, as you know, is very large in terms of residential office,
commercials. Yeah, correct.
So they even have, for example, a total of about 55 million square feet of office space leased out.
Right.
So Chalet does a very simple thing of saying that they're going to establish themselves within this office premises.
Correct. So you've got a tech park and then there's a hotel right next to it or within it or whatever.
Right, so if Raheja's got Mindspace, then they'll probably have a Chalet hotel there as well.
Correct.
So that becomes like a good attachment there.
Right.
So they benefit out of 2-3 key drivers. One is corporate events.
Right.
So if you're doing like a exercise
annual retreat or whatever, right? Your year-end parties and all of that.
Yeah, or a planning phase or whatever. Right? So corporate events are like a major revenue source or like a conference or whatever.
Correct.
Second is you've got corporate contracts. So usually if you're in Hyderabad, for example, and Wipro has to, just as an example, or IBM or whoever, they have to keep sending their management to Hyderabad
Correct.
to manage stuff or look after things. They'll get into a long-term contract with a hotel. So they'll say that, hey, you know what, give me a 10 to 20% discount on your usual rates.
And we'll occupy these many nights and these many rooms.
So 100 to 250 nights is a contract. And that can be divided across people or however they want.
Correct.
So that becomes like a very annuity based revenue model where you've got visibility.
Correct.
You're compromising a little bit on your
rate you're charging, but you know that there's fixed demand coming for X number of nights and X number of rooms.
And obviously, like hotel industry being one of high operating leverage, you start benefiting at a profitability level whenever this happens. And the third is getting a space in mixed development parts of any city. So Chalet is a good example of something where they've been able to take advantage of exactly this to the extent that about 40% of their exposure comes from business travel, which is higher compared to the others.
Makes sense. So you've got your luxury, you've got your business corporate travel, right? Is there anything else that's on the rise?
So the last bit is it's actually not a type of hotel or a type of travel, but it is a model of how hotels operate.
Okay.
So there's something known as a asset light model. Okay. So essentially what happens is a hotel will manage a property, but not own the property.
Understood.
So Siddhanth, for example, has a lot of money. He's got 1,500
it's
crores.
only an example.
And you've got land in prime area, right? You've inherited it in BKC.
Correct.
And you've got whatever, you've got that space. You'll get into a contract with Taj, for example, and Taj will say, build it out in this manner, use our expertise, blah, blah. You'll build it, capex is on you. You take care of the construction, everything involved with making the hotel. But Taj will come and run it.
Understood.
So the brand will be Taj, the staff will be Taj, the training, equipment.
So the expertise and the brand is where they come in, right?
Yeah, because that's the whole point why you go to a brand. Right? So rather than Siddhanth starting his own Sid hotels, it's going to be
which nobody is going to come to.
It's going to be a lot better for these guys, right? So and it actually so the benefit. I want to sort of dive into the unit economics of this just because it's so interesting. So basically what happens is if you own a hotel, you make about 30 to 35% EBITDA margin.
Okay.
High margin business, but still 30 to 35%. If you are going in a managed model, you make EBITDA margins of 70 to 80%.
Okay.
It's
double.
Huge. Yeah, it's double. And the capex requirement, say we'll take an example of setting up a hotel which is 100 rooms. Right. Now, I'll give you this unit economics in per key, like per room, per key metrics. So the land is going to cost about 3 to 5 crores per key.
Okay.
100 room hotel, right? Construction will cost 5 to 8 crores.
Right.
The fixed equipments and everything will cost about 2 to 3 crores.
Correct.
Working capital will be 1 to 2 crores.
Right.
So the total cost of setting up per key comes to about 10 to 15 crore.
Right.
100 rooms, it comes to 1,000 to 1,500 crore.
Correct.
So that is the amount of capex that will go in.
Right.
Versus if you actually manage, the amount of one-time expenses you have to incur are at a group level. So brand building will need about 5 to 10 crores.
Correct.
Putting in systems and tech will take about 10 to 20 crores, which is again scalable.
Right.
So a total of 15 to 20 crore of a cost.
Right.
Versus 1,000 to 1,500.
So it's a lot faster also, I'm assuming this, right? This model.
No, not really. Construction time is going to be the same, no?
Construction time is going to be the same, but you can
get in midway. You can outcut somebody and say, I want this.
Right. I know what you mean,
But, and so that is the setting up economics, right? But when it comes to running, and that's why the margins are so much higher, is that look at a owned hotel, for example. If I own and manage it, I'll, for example, get about 70 rupees of revenue from rooms.
Okay.
About 20 from F&B and 10 from others, events or whatever, right? Leasing space out. So I make a total of 100 in revenue. Now, out of the 100, staff will cost me 25 to 30. Utilities will be 8 to 10. F&B 8 to 10. Whatever other costs including, it comes to about 65 to 70.
Right.
So I make a EBITDA of 30 to 35. Now come to the managed part. Managed me, what happens if we go back to Sid Hotels as an example. You own the hotel, so you're making 100.
Correct.
Same revenue, right? But Taj is managing.
Right.
So Taj will charge a management fee of, on the 100, 2 to 3.
Okay.
So 2 or 3 rupees they'll charge as regular management fee. Now on top of that, they charge an incentive fee as well.
Right.
Which is if they perform well, they get higher incentive fee. So that is usually either 8 to 10% of gross profit that they make, or 15 to 20% of adjusted EBITDA.
Okay.
So on a blended basis, it comes to 7 to 10 rupees.
Okay.
So if you're making 100, Taj will take 7 to 10. On that, the cost is only 1.8 or 3.
Right.
So I end up making as Taj, I end up making a profit of 5 to 8.
Understood.
5 to 8 on a revenue of 7 to 10.
Correct.
Essentially 70 to 80% margin. So it's a beautiful business to be in. So the third driver is companies suddenly realizing that, hey,
we don't need to own our own property. We're good at managing property and we're good at running these hotels. So we might as well just stick to that.
And that's a conversation we've had several times now, right? Because when it comes to, say, manufacturing of electronics,
correct,
brands are great at branding and tech or product development. Manufacturing can be given to somebody else.
Correct.
That's happening. We've spoken about this in a lot of
different industries and sectors. Yeah.
So similarly for this one as well, it works out beautifully where your job is to do brand development, give your expertise, maintain standards, maintain efficiency, bring in business development, and let the ownership be with somebody else.
Correct. So, okay, so now essentially what we've established is you've got your luxury model, you've got...
So there's an example in this also, sorry. Now that you've given examples in the first one. The example in this is Lemon Tree.
Okay.
So Lemon Tree is a hotel which has gone very aggressive in terms of ramping up on their managed model. So while, for example, I'll go back to the previous one, where IHCL would be about 7% of their total revenue comes from management income. Chalet will be at about 6-7%. Lemon Tree is at 17 or 18%.
Okay.
So they've ramped up significantly compared to the others.
So doesn't Lemon Tree though fit into the business corporate travel hotels also?
Yeah.
It fits into this model as well, where it's managed, they manage it and somebody else owns it.
Yeah.
And it sort of is moving towards the luxury segment, right? I wouldn't call it a super 5-star hotel. I know Lemon Tree is not that at that level, but I've seen them having certain 5-star properties in cities in India.
Yeah. So I think, you've nailed that right. If I have to, so if we're saying that within travel as a space, these three themes are great. Lemon Tree actually kind of fits into all three. Their proportion of luxury hotels is not really that high right now.
But they're moving towards that space,
they're moving towards it. So that's what I think the differentiating factor or the, let's look at it this way. One way of analyzing something is to say what fits best right now. The second order that you can think about is what is moving where.
Okay.
So to say that luxury is a great space. Okay. IHCL fits there right now.
Correct.
However, what IHCL is doing is it's aggressively adding on its mid portfolio. More than it's adding onto its luxury portfolio. So there is Clarks which they acquired, Ginger which they're going aggressive on. Then whatever. There's one more that we spoke of.
Selectors.
Vivanta. That they're going on. So they're moving from an average, say, daily rate on a portfolio level of, say, 100. They're moving lower.
Correct.
Lemon Tree from 50, they're moving towards higher. Because they built something known as Aurica, which is your 5-star properties. Aurica is the one which is competing with the luxury category.
So what, Aurica is a separate brand under the Lemon Tree parent company?
Like IHCL has so many different brands under. It always makes sense for hotels to also go sub-brands.
Of course.
So Aurica is their luxury property segment, which is growing pretty aggressively. So I would not just, when it comes to investing, look at what fits the bill right now, but I would sort of go second degree and see what is moving towards my desired space. And that's where I think Lemon Tree is moving. So typically what happens when it comes to valuations as well, before you ask.
I was about to ask. I don't know why you're gatekeeping it for the last 30 minutes. That's all they want.
Is that when it comes to valuations at this point in time, IHCL commands the highest premium. They command the highest premium because of one, sheer scale and size, the brand moat, and because they're in the desired space of luxury. Now, if luxury hotels command a higher premium and somebody is moving towards that or gravitating towards that, I would imagine there would be a derating there. Whereas if somebody is moving away from it, there would be a derating.
Correct.
Re-rating and derating.
Yeah, that's right.
So that's what typically would happen in terms of direction.
Right.
So without giving away too much,
Makes sense.
I think, yeah.
So I think that sort of summarizes where the hotel industry. I know it's a different podcast because we're not really talking about one stock or one company.
Yeah.
But I think that sort of summarizes where the industry as a whole is moving.
Yeah. So the overall, I mean, valuations have already accommodated for a lot of this because it's not a surprise. It's been going on since 3 years that demand is exceeding supply.
Right.
People also know that for the next 5 years, this is going to continue.
Correct.
It's not. It doesn't require some a glass bowl to figure it out. So this is known.
Correct.
I think hence it becomes very tricky to select a stock or play a theme.
Yeah, because you can't just be like, okay, this industry is going to do well, I'm going to buy every stock within that.
Priced in. The markets are not stupid.
Correct.
It is priced in. So the trick is to figure out what has not happened or what is going to happen.
Correct.
And that's what we last spoke about.
Fair enough. Anyway, I think that's all for today and this week. Thank you so much for listening. Let us know in the comments if you want us to do more podcasts on sectors and industries, or do you want us to go back to talking about individual stocks and companies. Thank you so much, and we'll see you next Tuesday.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.